All right, good afternoon, everybody. Event Trader here, and I am being joined by chart trader Brett Manning, of course. Brett, how's it going?
Yo, pretty good.
That's good. That's good. I'll tell you what, Brett. Why don't we start off this session with something that you broke into that I think is important because obviously oil's been a pretty big focus, and I don't think you've been on yet to talk about some of the moves that we saw over the weekend. But you were talking a lot about some of the positioning in oil that could be impacted with that big jump that we saw following the attacks on the Saudi Arabian oil field. You want to bring that all together for us, and maybe talk about some of the things that you're seeing in oil and potential opportunities there.
Yeah, sure. So, I mean, in some sense, it's a question of when and where that this is a short. I think that has to be the case unless there's a sustained sense in which something has changed about the geopolitics of the Middle East, where we're just going to see repeatedly this kind of thing, and it's tough to stop. That would be the only case in which this is not a short, but the question is when and where. And when we've seen oil shocks in the past, there's an insidious dynamic that grows up because it's just like a company that it has got huge problems, but there's a lot of short interest, and then they get some kind of, I don't know, some kind of credit line or credit facility or something that allows them to stay liquid for longer, and you get a big short squeeze. At some point, it's going to roll back over, but the question is, where's the squeeze going to end? And you can really get bitten by trying to fade something like that too early. And in cases like this, you can get a similar dynamic, and what that's really made of is, if you think about the people who need oil on an economic and industrial capacity, and I think of airlines as an easy example just to understand the situation. If you're American Airlines, you have to buy a certain amount of oil in the form of jet fuel after it's been refined into jet fuel, but they're perfectly in sync in terms of pricing. So you have to be able to respond to that. And when you get a large jump in price, you're trying to figure out what your cost basis is going to be, let's say, for the next quarter, looking through the end of the year, so you can understand, your books and your projections and budget for the quarter and everything like that. And that's where their hedging traders come into play. When there's the possibility of some kind of temporary supply shortage, they have to buy oil futures to be able to lock in a certain price. So they're buying oil futures so that they can lock in the price on their jet fuel, because as the price of jet fuel goes up, so will the value of their oil futures contracts. So you can scare commercial hedging traders into purchasing oil by getting them to believe that the price could go up significantly further than that. Now, there's a lot of folks that speculate in oil on the basis of this kind of thing, and there's a dark side to the oil trading market, which is, long side spec funds that actually engage in the process of disinformation about the potential for geopolitical supply shocks to try to form a market that's based on, a profitable process of buying oil futures and getting commercial hedgers to be forced to buy and then covering into that. So that's something that happens. And it happens much more when you've just had something like an event that we saw this weekend happen. When you get actual geopolitical action that is meaningfully constraining supplies from a major producer, you're going to get a lot more of that. So that's one of the big dynamics that's in play here. It's information being put out there to try to make people more afraid of higher prices in oil, because that forces a squeeze. Because if you think about it, the airline in this situation is structurally short oil because it has to purchase it in the future. It's the same thing as being short. So you have major companies around the world who are synthetically short oil. They have to buy if the price looks like it's going to go up a lot, so they can be squeezed. And that dynamic is now in play. And the question is, how far can they get that to go? On the other side of that equation, what's dampening that response is that there's people who are synthetically long or structurally long oil, and those are oil producers, right? So they've got oil in the ground. That constitutes a long position. They want to sell it at some point. If the economically viable price of oil, all other things equal, and a lack of geopolitical problems, is around $55 a barrel, and you can suddenly sell at 60 or 62 or 64, then you're going to sell your future oil, your oil in the ground, now. So And when you get an event like this, you've got a lot of liquidity happening in next month's contract and the month after that. The oil futures all the way up the curve are much more liquid now following this. So it's easier to sell for even a major producer. It's easier to sell a lot of supply in the December contract, January contract, et cetera. So you can sell out up the curve to then meet it by producing that oil over that period of time and putting it onto the market. But you've already sold it at a better price than you think oil is going to be trading, because oil really isn't worth $60 or $62 a barrel right now in the absence of something like Iran sending missiles into an Aramco facility. So
is there a bit of a lead blanket offering with that, though, Brett?
Well, there's two forces that are battling each other, right? So you could look at that as a lead blanket offer from producers selling forward supply, which is depressing the whole curve, and the term structure looking forward. But it's downward, right? Because they can sell future oil now at prices that are above what they probably believe is the value of that oil in the ground over coming months. That's a great opportunity. They're going to take advantage of that. But on the other side of that, you've got commercial hedgers who have to worry about the risk that oil is going to be at 75 or 80 in a month, and that American Airlines is going to be in a difficult position because it hadn't budgeted for jet fuel costs like that. So they need to lock in the price, because if this escalates, let's say the U.S. responds to Iran, and then Iran's strategy is just to basically try to take out oil suppliers all around the region so that the world starts clamoring for allowing Iranian oil back on the market. Who knows? But if that's the strategy, and this is something that escalates significantly further from here, then oil could be at 75, 80, $85 a barrel. So the hedgers right now have to say, well, what if there's a 5% risk of that? Well, they've got to have some hedges in place just to account for that risk. And those are major buyers, right? I mean, think of all the airlines in the world and all the jet fuel they use on a daily basis. Or you've got, freight trucking companies, or there's so many. Oil is used in plastics, and I mean, so much of the world's industry is a structural demand for oil on a daily, weekly, monthly basis that's not going anywhere. And a lot of it is in the hands of large players who have commercial hedging operations. And their business model is predicated on their ability to have some predictability in terms of the pricing they're going to get for their base input. So that has to be accounted for. So both sides of this equation, there is a kind of commercial element that's probably more important than the trading element. And obviously these guys are watching the same headlines we are. And it's just a battle. And I really haven't seen myself say, okay, I see a trading setup right now, because I want a little more clarity on what the narrative is going to be. There's going to be time to short it if it starts going down, and if you realize that we're diffusing the situation tremendously. There's enough room to move here that I think you're going to get trading opportunities one way or the other. But my suspicion is there will be some further scare of some kind. I don't know if that's necessarily the case. We have an administration right now that clearly doesn't want that for several reasons. One being that it's just biased against it philosophically in the first place, and two being that it's also really kind of, this White House looks at the price of oil as a tax,
right?
And believes
particularly when they're worried about the Fed using inflation as a reason for not moving forward. And obviously gasoline prices will be jacking up. I know, just anecdotally speaking, Jim was talking and driving in, place where he was getting oil for $2.50 a gallon just last week was all of a sudden at $3.25, and he was asking about the dynamics there. So,
well, and if that was because of demand, that's a different story. But a supply shock is the worst version of that, right?
Right. No, and I agree, but it is funny because this is the biggest supply shock in terms of million barrels per day on record from what I was seeing. I was going back, and this included the Iraq-Iran war, the 2003 Iraq war, the invasion of Kuwait, all that stuff. Yet it's only 5% of total global supply. It really just speaks to the change in dynamics on where supply comes from, and the U.S. becoming such a large producer now.
Yeah, and it's a bit like saying, if the Dow drops 1,000 points, that's like 1987.
Right, exactly.
It's really not quite, it doesn't mean the same thing, so apples and oranges. But yeah, it's still a big deal, but it's a big deal even more so if it represents the first step in a process that's going to be a much bigger version of this and a consistent geopolitical theme that defines the next 6 months or a year. It's either that, or it's not at all that. It's a one-off thing. It's going to diffuse. It's going to resolve. Those are two very different paths that have very different implications for the oil market and very different implications for this tug of war between these commercial players that we've just described.
Right, and the other knock-on effect too, I would say, that needs to be watched is if gas prices do jump up and remain elevated, how does that hit the consumer, given that the consumer has really been the linchpin of this U.S. economy?
Yeah, and I think that the people who are the most concerned about that are the Saudis.
Yeah,
because they're the idea of being a reliable and stable source, it gives them geopolitical leverage. And if people start to question that role in the world, then they have suddenly a lot fewer friends, and everybody is starting to develop a different form of a global oil market that doesn't put Saudis at the center.
Yeah, and I gotta admit, I'm fascinated to find out how this evolves, because there's so many different directions it could go in.
It is fascinating, yeah.
But do you have any trades in oil that you're looking at? Then are you looking to short it at this point, or are you just kind of watching things play out? Are you going to be watching a commitment of traders report on Friday for clues on what's going on?
It's going to be very interesting. Will
the COT data have this?
Yes.
Have this event in, because it goes through Thursday, right? Or is it
Tuesday?
Tuesday, okay.
This Tuesday.
Today.
So Friday will reflect up through today. So, and the massive repositioning that's happened in the last 48 hours will be there.
So that'll be one of the more interesting COT reports that we've seen in some time, I would assume.
I would wager to say it would be the most interesting COT report of the year. Yeah.
Okay. Nice. Okay, well, we'll keep an eye out for that. Anything in particular you're looking for that would have you leaning in one direction or the other based upon your theories here?
Well, I mean, you got to remember, we saw a big drop in oil right ahead of this. So it's really interesting to see, did we see a big drop in large speculator interest in oil right in front of this, which has implications for how you interpret the chessboard following this. Were people malpositioned and then jumping back in, or were people holding positions and now getting overextended? And in the latter case, we could see a lot more reason to start shorting. If this is something that on this basis gets people back up to, let's say, 550,000 net long, that really starts to get you licking your chops for trying to figure out when this is starting to diffuse itself and move back lower, because you're going to see an overreaction on the other side if that's the case, which means you go down through the top of that breakout range at 55, 56 and tank down to maybe 50. Who knows? You could see an overreaction on the other side, and this starts to look like a symmetric pattern if this turns out to be a non-factor in estimates of global supply looking out the next 12 months.
All right. So moving over to the sentiment data then, Brett, I wasn't really seeing anything that was jumping off the page to me. It's pretty similar to what we were watching last week from my vantage point. I suppose one thing that I would look at was the hedge fund exposure starting to move in towards the extreme pessimism side of things, which obviously could start leaning towards more money being put to work. However, it was kind of running, and we'll get into both the Bank of America fund manager and their flow show surveys here in a second, but it seemed to be running against what I was seeing in the cash positions that were going on there. So do you find anything interesting on that hedge fund exposure read?
Yeah, so just exactly what you just highlighted, and I would say that the resolution of those two ideas is that this is the buildup of a large hedge fund short. So I think that you've got a group of hedge funds that are on one side of this market, a group of hedge funds that are on the other. We're not seeing, I think, necessarily selling by hedge funds who were long and bullish and are growing pessimistic. I think that we're seeing, just the two armies develop in the hedge fund community. And, one is on one side of the tape and one is on the other. And so the net result is, if you look at that hedge fund exposure index, you end up with basically, we're right at the 0 point, right at the midpoint. And that what that means is that there is not positive nor negative correlation with the S&P and the HFRX indices. So the performance benchmark indices for hedge funds are completely uncorrelated right now with the S&P. They're not positively correlated. They're not negatively correlated. And one way to look at that is half of the hedge funds are probably positively correlated, and half of the hedge funds are negatively correlated, and it's canceling
So
out.
bit of a tug of war, kind of like the
Yeah,
hedgers in the oil
and
position.
you can imagine. I mean, isn't there a tug of war inside of you? There is one inside of me.
Yeah.
So I think there's one inside of a lot of people, and people are falling on one side or the other of that fence right now. When they're, when you're taking a look at what's really going to happen here, as we move toward, into the fourth quarter and into year end.
With that in mind too, I'd note that CNBC's got their Delivering Alpha conference on Thursday, so I'm curious to see some of the commentary. There'll be a lot of big hedge fund managers speaking there, so you probably get a good idea of that tug of war being laid out in that situation, I would think.
Absolutely.
One of the other things that was catching my attention too was that inverse ETF, which is swung back down and is looking more like it's running around that extreme pessimism side now, or
that in a big
optimism
term
side, I
structure.
should
Both.
say. Yeah. So from that aspect of things, do you view this more as just the retail trader getting a little bit more excited?
What I view this as is we went through a period in August where we had genuinely developed a lot of pessimism, and really it was driven by a manifestation of very tangible recession risk. The sense that, perhaps the cycle is ending. We're starting to see the ECB move back toward QE. This is even before the ECB meeting, and we're seeing this just across the board inverted yield curves, and you get a couple data points that start to confirm that a little bit. You get the U.S. manufacturing PMI move into contraction for the first time in years. You start to see these ideas, and at the same time, it looks like at that point there's no end in sight to the U.S.-China trade dispute, and all of that kind of added up to recession probabilities being put out by a number of different big players, heading toward 35, 40% over the next 6 to 12 months. And we get past Labor Day, and you see a couple better data points, and it starts to feel like there's a different spin on things suddenly. The idea that maybe we're seeing a lot of this craziness in the bond market and a lot of these inversions based on some more technical issues and some more global fungibility flows between different sovereign debt markets, and a dynamic that one of my two characters arguing at the beginning of my last chart book talked about, which is how people are monetizing negative interest rates with dollar funding flows and basically purchasing something like German bunds in negative territory and using that to set up and sell Forex hedges so that people in Germany who want to borrow from their government at negative interest rates and then buy U.S. debt and take advantage of it, they need a currency hedge. And the combination of the two allows you to actually purchase negative yielding German bunds and end up making a positive return because you get about 100 more basis points when you sell the FX hedge on the other side of that. So a kind of cottage industry is built up, playing the difference between a positive yielding major sovereign debt market and a negative yielding major sovereign debt market that's exacerbated some of those effects. And there's a few different refinancing dynamics and other elements that are kind of part of maybe why people are starting to accept a different model for what we've seen in the bond market. And at the same time, then you see, a good jobs report and other, the Citigroup Economic Surprise Index has turned positive for the first time in months. So there's kind of this reframing of reality that I think has happened following Labor Day. And we saw, I think Goldman Sachs and Bridgewater and a couple of others come out and take their recession forecast, the recession risk indicators, down from like 40% to like 12 or 15%. So, you've seen this kind of process of, oh, wait a minute, this was a weird kind of acid trip we were all on during August, and now it's a little different. And markets popped up and started to break out to the upside. At the same time, you get this sort of notion of a thawing relationship between the U.S. and China. Whether that, I really, I don't see there being any legs to that in any practical or real sense. But there's all of this roller coaster of geopolitical and macro sentiment that we've been on is right now at a point where I think it makes sense to see inverse ETF volume down really low. There's not a lot of people betting that the market is going to roll over, that they're going to get rich by buying an inverse ETF. And that's where we were as of mid-August. We were a lot of people feeling like they were going to get rich by buying an inverse ETF, that it was just going to take off to the upside. And at the same time, the VIX term structure kind of shows a similar picture, right? The VIX term structure is essentially, as I've framed in the past, it's essentially about saying, is there going to be a crash right away? Is the uncertainty about the next couple weeks greater than the uncertainty about 3 months from now? And when you see a VIX term structure that's backwardated, that's what basically people are saying. They're saying that anything can happen in the next few days. We could see some kind of flash crash, who knows? But months from now, things are probably going to be more stable. When you see that kind of crash risk come in, that's how it looks in the term structure for the VIX futures market. And right now we see sort of the opposite situation. People are pretty confident that there's no real major crazy thing that's about to happen right now. So you could look at that as in both of those cases that we have seen a reasonable foundation for the development of some complacency. But it's not, I would say, anything like exuberance. And I don't think it's a reason to take a contrarian short in the market, but it maybe starts to build the underpinnings of a vulnerability if we bake in some exuberance.
Yeah, that's obviously interesting that you talk about some of the tools that are on in the market and the financial funding going on, because we are going to talk a little bit about that repo rate that's been getting so much attention in a little bit. But one of the things that I found interesting that kind of goes against what you were just saying there in terms of the inverse ETF structure, and that was, we'll break now into the fund manager survey, Brett. And one of the things that I was catching there was the recession risk rose to the highest level since August of 2009 in this survey. Now, to be fair, it was kind of a little bit of a cross data point, I felt, with some of the other data that we're seeing, because
this survey is over the last month, so going back to mid-August.
Okay, all right.
It's a monthly survey.
Right, but also it just kind of went against, there was a small pickup in global growth expectations to minus 28% from minus 48%. And but there also was an insufficient boost to the EPS outlook, with a lot of people looking for EPS to decline 3.1% year over year. Something that we're seeing play out in some of the downgrades that we've seen in some of the profit warnings. But the recession risk, then, you're simply looking at that as dated. I
think so.
As a dated survey.
Well, what I would say is it spiked in August, where we got to a point where the recession risk projections spiked in August, and then just over the last 10 days or so, we've seen it kind of recede. If you look at the 10-year rate, you can see the same thing. Right. So just follow that out. I mean, by the mid to late August, we were seeing a 10-year of almost 1.4% on the downside, and then it's dramatically reversed that run, and now we're back up above the 50-day and almost at 1.8. So you can see this same dynamic, I think, happening there, where we had kind of like a panic about recession is coming any minute now, and then something changed. And I think that inflection is the same thing.
The better data points. You think that's a key, like that we're not falling off a cliff and still getting monetary stimulus?
I guess I'm not exactly positive. I think that in part also it's just this. I feel intuitively like there's some degree of reframing the inversion of the curves, like that we're starting to come up with more interesting and detailed explanations for why this curve inversion on the yield curve is different this time. I think that process has happened somewhat successfully, so that people can see it's possible for a major curve inversion to happen and it to not mean the same thing that it did in the previous 8 times over the last 50 or 60 years. And maybe that's wrong, but I feel like that's what's happened.
I feel like it's easy to explain it as such, given the central bank activity and the fact that really nobody knows.
And that is different, right? That was not the case over the last 50 or 60 years in the other 8 instances. We didn't see $10 trillion worth of central banks buying sovereign debt. We didn't see, all of these extraordinary actions taking place. We didn't see such a massive number of $17 trillion of global sovereign debt trading in negative yield territory. That's all weird. That's like a funhouse mirror version of yield curves around the world. And it's just to say that an inversion just means you're comparing the long end with the short end. But if the whole thing is skewed so far away from where it's been historically, maybe it doesn't mean the same thing. And I think that people were just taking it as, it's always wrong to say it's different this time. Those are always the fools in the end. And I think we got a momentum in July and August of saying, well, this obviously means something big. And every time you see a data point that confirms that perspective, like the PMI manufacturing, just going into contraction territory, it's just this huge reinforcing dynamic in August of saying, well, the curves were right. Here we go. Recession's on the way. And I feel like there's been a perceptual framing shift since then. And really, I really feel like it's sort of post-Labor Day for whatever reason. Just folks kind of came back to their desks and just took a look at things. And there was an intellectual and cultural shift in markets of kind of seeing how this may really not be this may really be a unique kind of dynamic that can be viewed as something other than necessarily heading toward the imminent onset of some recessionary data. So I feel like that's what's happened, and I think that we see a lot of that in terms of how markets have responded since that point. And I think that some of the big firms, tracking back on their recession forecasts and interest rates starting to pop higher, because whatever element of that interest rate move was about people kind of tumbling into a momentum of seeing the recession boogeyman right around the corner, has started to come back out of that market. And it obviously that could be wrong. That I don't know, but I feel like that's what's happened in terms of the perception.
Yeah, and I think some of that was evident in that drop in the cash levels that we saw in the fund managers survey, as it fell to 4.7% from 5.1% there. So that obviously highlights kind of what you're looking at, Brett, with the money moving off the side. But again, that kind of goes in contrarian to what we're seeing in the hedge fund managers. So do you think this is simply a kind of a matter of the dumb money at work, or like nothing along those lines, just kind of something that needs to work its way out in the coming weeks?
I think everybody got on the same emotional roller coaster, and I suppose the data at this point doesn't exactly look recessionary. So, there's a lot that can be done here, and maybe this is a good time to transition to the next point, which is what I found another interesting point from the fund manager survey out from Bank of America Merrill Lynch that hit this morning, was the number two biggest tail risk is impotence of monetary policy.
Right.
And I think that really is headed for being number one.
Yeah, and just so people are aware, so trade war came in at 40%, that monetary policy impotence at 13%, bond market bubble at 13%. You could probably kind of tie them together, right?
I think you could, but I think the emergence of it being considered a tail risk and being considered a large tail risk, I think over time we're headed toward the process of starting to worry more about the fact that there's no safety net. And one of the big points that came up in the survey, I guess, in a number of different ways, is the idea that if there's something that could unleash all the money that's been sitting in very protected positions and really accounting for this big skew between growth and value, and leaving a lot of these stocks who may be really cyclically tied in but are being left to just wither, rather than being picked up as value, looking for some kind of resumption of growth. All of that really may be tied to whether or not we start to see more stimulative fiscal policy.
Yeah, and
that's
obviously something built off of from Draghi on Thursday, where
this is becoming a big so I'm saying the culture of the market is becoming really aligned toward this theme.
Yeah, which would certainly relieve a lot of central banks around the world, the idea that they don't have to carry the load here after 10 years of trying to do all the heavy lifting.
Well, so something that we talked about last week just a little bit, monetary policy, I think that to throw another metaphor out there, which I love to do, I think monetary policy is a little bit like voodoo doll magic. Like if I make an effigy of you and I poke the effigy in the shoulder with a needle and you see me do it, if you are a true believer in voodoo, your shoulder will hurt. You see what I'm saying? But if you don't believe in voodoo, it won't really have much of an impact. And monetary policy tools, to a great extent, are kind of based on a similar logic. Like the central bank is moving symbols around in a separate world from the regular economy and hoping that people in the regular economy believe that what they're doing is going to have an important impact and then respond to it. And that's how
we haven't
monetary
really
policy
seen
works.
that in 10 years. That's the rise
Because
of
we've
populism,
used so
right?
much of it. If
Yeah.
you have a culture of true believers of voodoo and you start doing tons of voodoo doll magic all over the place, there's going to be lots of opportunity for people to have experiences that aren't consonant with that belief and start to doubt. And the second you doubt it, your shoulder doesn't hurt. And it waters it down. And we've used so much monetary policy all around the world for the last 10 years that I think that we have really basically, you can look, there's a lot of different metaphors that work here. Another one would be like a drug tolerance kind of thing. You use so much of it that you no longer feel it or whatever. But I like the voodoo example because it really does get to the point that it takes a faith, it takes a belief that this is actually that what the central bank just did actually has an impact on, other things in the economy where there isn't necessarily a relationship. The relationship is filtered through some kind of collective psychological dynamic. And if you use it so much all the time, it's going to gradually lose its magic. And fiscal policy isn't subject to that. You're actually changing elements of the real economy. Yeah. So
Yeah,
I think we're getting
in fact,
to that
in that
point.
survey, the top three most bullish policy actions, right, Brett? German fiscal stimulus, 50
Yes.
basis point cut by the Fed, which we'll get into in a little bit, and the third one was China infrastructure spend, right?
Yeah, right. So these and look at how far down ECB QE is in that same table.
Yeah,
It's nothing.
varied.
Look at the difference between German fiscal stimulus, and this is we're talking about several hundred large fund managers here, basically saying, German fiscal stimulus would be 6 times as powerful as ECB QE, and that go back 10 years, and that is not the case. German fiscal stimulus would have been yawn, ECB QE would have been wow, and now we're in the exact opposite world. With the fiscal stimulus coming out of Germany would be somewhat of a game changer, but would it also start a political problem? That Germany's asking everybody in the South to be austere, and then it's doing fiscal stimulus in its own economy. So that's the other.
Especially for an export-driven economy too. But that is viewed as being one of the best paths for steepening this yield curve. And the other thing that I found of interest too, and we're starting to see it in some of the data, is for the second month in a row, inflation expectations were on the rise. Now, granted, this was against a multi-year low,
Yes.
so you have to take that into context. But we are seeing a little bit of movement towards inflation, and some of the hotter data that we've seen over the last week probably helps play into that.
Say that again. Sorry.
I said some of the hotter data that we've seen over the past 2 weeks probably plays into that with CPI and PPI.
Sure, it's a resetting
territory, but yeah, it's resetting exactly.
It's a resetting of normalization. It's normalizing, right?
Do you expect to see? How do you expect that to play into the Fed tomorrow? Or probably not at all.
Look at these Fed funds futures. You noted it yesterday. We're now at nothing.
Yeah,
we're now at 57% nothing.
So I didn't see today. So wow, that fell all the way to 57%. That's crazy.
Now it's even. Now it's 50-50. 50-50 cut or no cut. Well, that's interesting.
Well, and again, we'll get in. We'll keep going through these fund manager survey and the flow show. But I'm interested to we're going to do a quick glance at the Fed. I think tomorrow we'll meet in the morning, Brett. Right?
Yeah.
Do a little bit of a preview. But one of the things that I want to break into is how this repo rate could potentially spur the Fed into action. But just taking a look again at the fund manager survey before we move on from that, was there anything in particular that was sticking out to you, Brett, on the fund manager survey?
It's the same. I feel like we're in Groundhog Day a little bit for a certain side of our conversation over the last 3 or 4 months, even though a lot has changed. But from the sentiment data backdrop, we see this consistent set of, I mean, there's been blips for a week or two here where things are more dramatic one way or the other, but for the most part, we've seen our short-term, highly quantitative different measures stay relatively neutral-ish, and we've seen a persistent sense of a lot of people sitting out the game. And what's going to tip that, and suddenly they get in the game. And if they get in the game, you have your sort of what the whole Icarus idea of this blow-off bull market kind of process. And if you unlock enthusiasm from all this money that's been sitting, boycotting risk assets and boycotting the equity market, knowing that something's going to go wrong here before long, and we're just going to sit in the bond market. And fiscal stimulus would be, well, certainly what's suggested in the fund manager survey, fiscal stimulus would be the thing that unlocks that door. If you start to get real, if people have lost faith in voodoo dolls, and you start to pour money on things, and it feels like, oh, the real deal is here now. We've got something that can work as a safety net if things go wrong, something that can stimulate where stimulus is needed, say Europe, Japan, etc. If we get to where we have tools, cyclical tools, to push and to try to get rid of all these inverted yield curves, try to get these rates up out of negative territory, all of that pours money into some of these highly cyclical value plays that have been beaten up so badly. So I think that there's that possibility that you could unlock this kind of late cycle extension to everything if you find this new narrative. And I think that that's been hanging around underneath the surface and between the lines of the discussions on this show for 6 months. And it hasn't been resolved. And it's just still the implicit possibility that you see an unlocking of a lot of money that's been tied up in just sitting on the sidelines and not being a part of the game. And I think that it's the voodoo doll problem that's a big part of that. And if Europe finds a way, I'm not buying that they can find a way. It's the reason why I'm short the euro is ultimately I believe that in a world where fiscal stimulus becomes the necessary path, that the breakup of the euro becomes the big thematic question.
Right. I would say this in talking with that monetary stimulus and sufficiency. Did you find it interesting? They did a survey of when do you think the trade war will be resolved. The trade war has been the primary concern for the markets in 17 of the last 19. And the number one response now, I think it's a pretty open-ended question in terms of resolving the trade war, right? Wouldn't you agree with that?
Never.
Well, but I mean, that's the thing. I'll get into that. So the number one response was that it will never be resolved, and this is the new normal. And that was about 38% of the respondents. Now, number two I found interesting. In 2020, before the U.S. presidential election, which I think it came in at about 28% there. And I think that's very viable with the idea that Trump tries to get something done in order to shore up the economy.
Okay,
but what kind of deal would that be? Like,
I was just going to say, it all comes down to the definition of the word resolved.
Exactly, and that was kind of my point with it. So I think the survey is a little tough to follow from that. But then next up, for if people are curious, was after the U.S. presidential election, kind of open-ended there. That came in at about 18%. In the next 3 years was around 10%, and in 2019 was down at about 4%. So, but again, like you said, Brett, it was a very open-ended question. But I think it plays into the idea that monetary stimulus or the ineffectiveness of monetary stimulus could easily overtake trade wars as the new concern if people view that this current environment that we're in is the new normal.
Yeah, exactly. And if it's not a variable, then it's not a concern. It just is. It's not, gravity is not the number one concern. Gravity's here.
Yeah.
We have gravity on it. So, people could say, whoa, what if we get gravity? What will that do to asset price? No, we have it. Like, if the China trade war becomes gravity, then, it ceases to be a tail risk. And I think that I think that that's exactly right. I think that this is going to evolve into a managed political relationship that could be around for decades on some level. We're going to have a dial that we can turn the intensity up or down on, depending on whether or not we're seeing good or bad trends in that relationship, and it's just sort of part of the fabric of our foreign relations.
Yeah. And so it's going to be interesting. And I think, you could see that if for some reason we did get a 50 basis point cut tomorrow, which I don't think that there's any
Pretty
chance
unlikely.
of that. So let's roll into the flow show real quick, Brett, and we'll take a look. There was a contrarian buy signal from the overall positioning that was being shown in there, pretty much in line with what we're seeing in the fund managers survey there. They were, talking about being bullish on risk assets, particularly stocks and commodities, based on this positioning. Whereas 2020, they were a little bit more bearish due to recession, policy impotence, and bond bubble risks, which again I think plays into that idea that monetary policy could become the biggest risk. Now, the weekly flows, again, 12.4 billion went into bonds and 7.6 billion out of equity. So it kind of reversed what we saw in the prior week, which was it's obviously not the new normal with flows into equities. So that equity flow seemed quick to be reversed.
Let me break in for one point.
Yeah.
So this is the 14.4 billion into equities. I think it matches up with the inflection in the if you look at sovereign interest rates, you look at the 10-year, the reversal there matches up with this, and it matches up with some of the big firms coming out and dramatically reducing their recession risk forecasts, and that whole process. I think that there was this sense that there's imminently something going to be terrible, and we're just about to see this confirming data point, and then suddenly it just goes away, and it's right after Labor Day, and you can see this flow show is basically that following week. And you see $14 billion flow into equities, and you see interest rates pop back up higher. You see money flowing out of gold. And there's not really one smoking gun reason. It just was an inflection of expectations and perception.
Right, and I mean, kind of running into that too, Brett, and again, circling back to that monetary policy theme, there is a record 160 billion of inflows to bonds over the past 3 months, which really points towards that deep global recession fear and global capitulation into Japanification, but that fiscal policy could offset some of that Japanification.
That's it. Exactly right. I mean, it's this that there's no. Remember that we talked once, and I said, if right before Jackson Hole, if I said, boy, if Powell could get on stage and say, today I'd like to introduce this new thing we've got, and it's this thing, it's going to be great, it's going to solve all your problems. We have a new tool, this thing. And if he could find a way, just like they did years ago in 2011, 2012, with different versions of QE and Operation Twist, and it was like introducing a new tool of monetary policy, a new voodoo magic spell that would reshape how financial markets and the economy worked in some powerful way. And it was the idea that we've got a lever and a button that actually impacts things, and it worked. And they don't have a thing now. And the idea that they're going to have a thing. People are just losing faith that there's any new thing coming. There's any new tool that central bankers of the world are going to be able to use that's got this really powerful impact on how financial markets and the economy work, generally speaking. And it's a lever and a button that actually has a genuine impact on things. And it's not there, and people are losing faith in that. And I think that when you look at the inflows into bond markets, I think it's around that. And it's the reason why I think at some point here we're going to see that the number one tail risk is impotence of monetary policy, and it really does mean that baton needs to hand off to a workable kind of fiscal policy. And let's remember that while the Eurozone looks like the least likely place for fiscal policy to be an easy thing to implement, that's just because of the structure of there being a single currency market, a monetary union, but not a fiscal union, and there being political populism that separates the countries. Inside of even the United States, we don't exactly have political functionality.
Yep.
We don't exactly have a House and a Senate that are going to get on board with the same sorts of policies, particularly when we're heading into an election. So there's a case that can be made that fiscal policy is politically unfeasible,
Well,
and if
that
monetary
was the
policy
funniest
is
thing.
impotent.
That was the funniest thing I found with the survey in terms of where they felt that the number one subject where there was bipartisan agreement was in infrastructure. This was over
Yeah,
China, and I just don't get that because
neither do I.
you got to be crazy that you think the Democrats would give Trump
No
a
way.
$2 trillion package in front of that,
No
and on top of that,
chance.
yeah, they could agree on a $2 trillion plan. Are you telling me that they can't agree on a budget, but they'll agree on where this $2 trillion
Now,
infrastructure project would be spent?
Now, let me go ahead and play devil's advocate. Let me go ahead and play devil's advocate on what we just agreed on. And that is the people who are voting for this, they want to win re-election too. And if it contains for specific Democrats in key places,
Enough
huge pork that
Yeah.
says you are going to be magic to your constituents. You're going to be the greatest hero ever because, boy, you were going to give you this.
Yeah, but again,
You might be able to get it done if you
Brett,
play that thing right.
You can't, Brett. You can't. You just laid out my
They're not
plan.
a team. They're a bunch of individual political entrepreneurs.
No, I get that, but like, I mean, so what's the Trump administration going to do? Try to placate just enough Dems to get that through? I just don't see how they
How
can
many
do
do
it,
you have to win in the House?
particularly in nine.
How many do you have to win?
For the I don't know. I'd have to see the number. Carmine would know that better, but I mean,
30?
I mean, you got to match it up with how the senator breakdown is. I would say about 20 to 30 in
You just got to
in
give
the
them
House.
real good. Yeah, you got to give the right things to people who are vulnerable and who need that. I don't know. I think that these things
think
happen.
that would be walking such a fine line. I just don't see it happening in that time frame. Not in an election year.
Yeah, I'm sure that the survey basically means that everybody realizes that both sides think that it's necessary to do. But
Yeah.
again, this is where we get to with what is politically feasible and not. Even if it's a good idea, it may not be possible.
Yeah, and again, that's also the deficit hawks and on the GOP side if they're still around.
Right?
But the other thing that I wanted to throw out there, Brett, just to kind of hammer home the final thing on what we're talking about is big bond inflows often precede the biggest policy changes. And we just talked about how there is a record over the past 3 months. This is looking at 2010, 2012, 2015. And it just also illustrates that the periods of big bond outflows, 2008, 13, and 18, coincided with the most bearish returns across asset classes. So,
And of course they do.
again,
You've got pessimism and optimism on a scale.
it's just lining all up for a change in philosophy. And that leads us to our final point, which we'll get into greater detail tomorrow. And that's just a quick outlook of the Fed preview, Brett. And I just want to touch upon this since we'll get into a little bit more detail tomorrow morning. But I want to bring in a kind of an unknown entity, and we'll discuss it as best we can. We'll probably do a little bit more research, but that Fed funds futures just collapsing from the potential for a 50 basis point cut a couple of weeks ago, which never, I don't think, got over 32%, right? Or in that range.
Sorry?
For the 50 basis point cut, that never really got
ever?
over the
I
last
think it
couple of
got
weeks.
to, I thought it was sometime in or August, didn't it get to maybe 50-50 on the 50?
Either way, the numbers don't necessarily matter as much as the trend, right? And again, that was you could have knocked me over with a feather when I went to look at the Fed funds futures, which I hadn't looked at in a couple of days, just assuming that was a done deal, to find out that it had slipped to, and this was yesterday, 67%, which I just was floored by. And now you're telling me it's under 60%, right?
No. I mean, we are now 50-50 for no cut.
For no cut, that's what I'm saying. It's at 57%. And I mean, I just found that incredible to see that drop off in expectations.
But it's the same thing. I mean, if there's one theme to this conversation, it's the $14 billion flowing into equities. It's the big rise in 10-year interest rates. It's the last 10 days.
Yeah.
It's like people went from wearing one color glasses to wearing a different color tinted glasses. and it just turned over. And I don't think that there's one thing that did that. Some people might say it is this thawing of the relationship between the U.S. and China, the difference in rhetoric. I do not think that's it. Maybe it's that, we're not going to see. I just don't think that the tariffs are part of that. I really don't. I think that it's the way that people were looking at those curve inversions and the gradual dissemination of a new perspective on it, that there's some technical factors in the bond market that are truly unique in the age that we live in, given what we've seen from central banks over the last several years and over the last 10 years, that we have had our finger so heavily on the scale, and we have such a depressed curve all around the world that when you start to get to lower nominal rates, generally speaking, that there are some different dynamics that start to enter into the equation. And the fact that we have negative rates, whole curves in negative territory, and other curves that aren't, and that we've got these strange technical dynamics in the plumbing that are growing up between them to link them together, I think that people are starting to reduce the degree to which they're looking at curve inversions as an economic indicator. And if you throw that out, you throw out the curve inversions and you say, okay, what does the data look like otherwise? It doesn't look like there's a recession right around the corner for the U.S. at all.
Not at all.
No. So that changed from August saying, these curve inversions, they always are followed by a recession, and we're just, we're on our way toward that reality. And then you see, again, that one-off, that manufacturing PMI heading into contraction territory, really kind of feeding into that. And then suddenly, if you throw out the curves and then you get a good jobs report, everything changes. And I feel like that's what's happened. You threw out the curves, you threw out the inversion as a data point in starting to speculate where we're headed economically. And when you throw that out of the equation and you just look at everything else, you don't see the same picture at all anymore. And I think that's what's happened. And we've seen a massive inflow into equities. We've seen a complete change in terms of the Fed funds futures. We've seen a big lift in long-term interest rates, all, I think, kind of tumbling to a conclusion.
Right, and basically had been seeing mounting evidence of a little bit more of a hawkish Fed, but something happened on Monday that could throw that off, Brett, and we're just going to touch upon that repo spike that we saw that really raised a lot of red flags. Basically, for anybody wondering, repo and reverse repo transactions, they're basically purchases that function as collateralized loans. It's the plumbing of the financial network. Basically, one party buys an asset from another, and then they promise to buy it back at a higher price, and that difference is the interest rate on the loan. And then the reverse is just the opposite of that, with the transaction initiated by the bondholder rather than the investor with cash. Now, we saw that pop up to 8.5% from 1.5% yesterday, and that raised just a ton of red flags that was going on. Basically, what that means, for instance, when Lehman Brothers went under, that's basically when repo investors, worrying that they were insolvent, just stopped rolling over their loans. So they lost funding to that. We've talked a lot about the corporate debt in America, and if you see this funding kind of roll out, then that just raises a lot of red flags, and that's what happened. Now, there were a few things that were seen as one-offs that could have impacted this lack of funding liquidity in the repo market. Number one was September 15th is when corporations have their tax days. So a lot of them are in the markets looking to find funding for money. Number two, the prior week in the U.S., there was an issuance of $75 billion in bonds. Now only $24 billion bonds matured. So that $50 billion difference was only the third time in the last 15 years, I think it was, that there was over $50 billion in redemptions. And what that means is there was less collateral for people to use in order to make these purchases. There's also a lot of talk about how regulators, with them putting a cap on what could be used in this repo rate, really handcuffed a lot of people. And then, of course, there's a lot of dollar funding going on by central banks around the world that would have also been impacted by this. So I think that there was a convergence of items going on that really squeezed the liquidity in this. But certainly raised a lot of red flags in the fixed income market. Didn't really see much of a reaction in bonds at all or anything. But Brett, just curious if you had any thoughts on this. And one of the things that I think this plays such a big role in it is we're also only 2 months removed from QE being out of the market. So the Fed isn't in there to provide some of the grease in the wheels that they had been over the last 7, 8 years since they started the QE programs. And number two was also the IOER rate, how that could play in. That's basically the interest rate paid to banks for the deposits that they hold at the Federal Reserve. Now, this is an instrument that the Fed could, two instruments between the QE and the IOER that the Fed could pull tomorrow. What did you think of the repo rate action? And Brett, I think both of us talked offline. Neither one of us are experts in this, but we have a relatively working idea of how this works into the financial markets. And number two, do you see this impacting the Fed tomorrow at all?
So I think that what we saw is the manifestation of some kind of major stressor. And I think that we're never going to know exactly what happened, but from a 30,000 foot point of view, I would be willing to bet that it is somehow related to exactly what we just talked about, that there's been a major inflection in how people are perceiving the underlying meaning of the extraordinary behavior we've seen in credit markets, generally speaking, over the last couple of months. And if that inflection is particularly meaningful, and also what we've seen in Fed funds futures, a dramatic shift in what we're expecting the Fed to do. And there are positions that people have and strategies that have been in place that have been upset dramatically by a shift in those expectations. And in a situation where liquidity is not high, clearly that's the case here. You wouldn't get a move this dramatic unless you have a liquidity issue, and the Fed has moved in to try to present more liquidity to correct the situation. I'm sure that they'll be able to do that. It looks like maybe they already have. But I think that it's a manifestation of some of the strategies that have been in place that have been predicated upon a certain type of credit market situation that maybe has inflected on a large level just over the last week, and we've gotten to the stress point of that where people who have been unwilling to accept that shift have been forced to on some level. I don't know exactly the precise details of how that was manifest in this case, but I would be willing to bet pretty powerfully that on some abstract level, that's basically what's happened here. And I think that certainly, it doesn't seem like something that will be a difficult problem for the Fed to deal with, but it's probably something that I think one of the most interesting points is probably consumed a lot of their time in their meeting. They've had to deal with this on a technical basis. They've had to focus their time and energy on this rather than quite as much time on, understanding where we are in the cycle and how they're going to present their ideas, how Powell's going to handle the press conference, et cetera, et cetera. So it's been, a big new item on their plate.
It'll be definitely a question asked tomorrow for sure in the press conference.
And we'll get some clarity, yeah. But I don't know if we'll get necessarily a straightforward explanation.
I think the minutes is where you'll get the explanation, where the minutes tend to go into a little bit more of the day-to-day operations there. Final question, Brett. And again, we will be doing a Fed preview tomorrow morning, so we'll have more to say on that. But brass tacks, somebody's asking if there's no cut, how do we trade it? And that's the bottom line, right? For me, I'd be certainly looking to short it, but I'd be very cognizant of a reverse rip higher on the short. So my general thought is no cut, short, small size, and be prepared to buy a dip is how I'm viewing this for the immediate reaction.
Yeah, I mean, I know that, obviously this, at this point, people are expecting a 50-50 situation. No cut wouldn't be, I don't think no cut would be a huge surprise. And if it's couched in language that says, turns out the economy's in a much better place than we thought, people are trading in front of Q3 data, in terms of earnings, those earnings are going to be better than people thought. I mean, look at what we've seen in terms of market positioning over the last week. That hasn't changed, how many people are buying stuff on Amazon or whatever. Like, consumers aren't in the world that we're inhabiting here as we look at the inflection of expectations. The general consumer is not keeping track of the yield curve inversion every day or the Fed funds futures.
No,
So,
but again, that harkens back to my gas outlook for the knock-on effects on the consumer.
so there could be a gas effect, but that happened so late in the quarter.
I would expect
data,
them to mention anything like that would be transitory. Would how I think that they would address
the Fed. Okay,
yes,
but
the Fed.
I'm just saying when you start to think about the reaction of a no cut,
Right.
I wanna buy a dip on that. I think.
Yeah,
Because
but
I think that. Go ahead.
and that's basically what I was saying. I think the initial reaction is selling pressure, but for people to come in and buy a dip because of what you're saying there,
It's pretty quick. 5 minutes later.
Yeah, it's a good thing if they don't cut, and it's because the economy's too strong.
Yeah, well, that's exactly right. Well, especially in front of earnings, right? Where, we may see a lot of beats if the economy has this whole time been stronger than we realized.
What do you think of Powell wears a Jerome and the Boneheads T-shirt for his press conference, Brett?
I think it would be an excellent choice. I think that's a good strategy. He needs to shake things up a bit.
Yeah, I'd be if they don't cut. I gotta admit, I can't wait to see what the tweets are because it's.
Oh
just,
my God! What a circus it's going to be on Twitter.
Trump's hairpiece might blow across America.
He's going to troll him during the entire press conference.
Anyway, all right. So, Brett, look forward to talking to you tomorrow. I think that's going to be it on our side. But Brett, you always do a great job at the wrapping up. So, you want to take us home and give us the summary of how you're viewing this with our focus on the change from monetary policy's effectiveness.
Yeah. So, I mean, I'm going to actually introduce a new thought sequence to the wrap up, which is. In my gut, I feel like we're on the doorstep to some really interesting markets to trade, and I think intuitively that's kept me a little bit quiet over the last couple of weeks. I feel like there's a lot of different themes that are seemingly very unrelated, and I in past times I felt like when I feel that way, eventually a more unified narrative starts to emerge. And I don't know how things are going to get tied together. I just feel like there's a lot of seemingly very disparate themes that are all converging to make the market that we have now like a lot of separate ingredients that are spread out on a tray, and then 20 minutes later you have a pizza. And we have a lot of different things that don't seem necessarily to have anything to do with each other. And I feel like that's going to start to coalesce into a more unified narrative, one way or the other. And I'm more of a spectator right now because I don't feel like I have a tremendous conviction about having an edge about what's coming next right now in this environment. I feel like I'm a little bit more biased to upside in the equities market because I feel like this inflection that we've seen over the last couple of weeks is a positive growth inflection, and that we're coming to a head on understanding that there are limitations to monetary policy, and that starts to form a drumbeat around fiscal policy. We've heard that drumbeat at a distance at this point. We might start to get commentary about it. And I think all of that can feed into some upside. People aren't positioned for that. People are still positioned incredibly skeptically, particularly in terms of large money players in the market. We haven't seen that tide break yet. On short-term sentiment indicators, we have a little bit of complacency coming in, not a lot. We have people no longer worried about an imminent crash of any kind. That can lead to shakeouts, so we could see opportunities on the long side based on short-term shakeouts. For example, if the Fed does not cut tomorrow and we see the shakeout because we have very little exposure to inverse ETFs, for example, we can see data on that. Right now, it's not there. So you've got retail hedgers are not really hedged in this market. They're not really short this market. If we get that type of piece of information, that input, let it play out. And then take advantage of it the other direction, because the larger bid is probably going to be there when the fever pitch of the initial shakeout subsides. So I think that's the kind of market that we have here, but obviously with all of these different big headline themes, and there's so many, you have the possibility of game-changing headlines at any moment. So, make sure that you don't put yourself in a position where you're over-levered to something really without an exit plan, because you can get hit with a tweet or a headline. There's so many different themes that can hit things right now, one way or the other, really, short or long, and across assets, obviously oil, gold, bonds, currencies, equity markets. There's everything contains that two-way headline vulnerability right now. So I think things are going to coalesce into a narrative where that's less the case. And I think that we're going to have better markets and more interesting setups when that happens. And that's a process. So be selective and really kind of be disciplined in terms of where you're setting risk. Always have an exit plan. But I think that you're going to get in the equities market in particular some possible shakeout opportunities on the long side.
Okay, and real quick, Brett, just two feedbacks. You're sticking with your short, obviously, with the same stop. No changes there,
Yeah,
correct?
sure. No.
And Gunlock headline too, saying the Fed is likely to embark on QE light, which I think would be basically in response to that repo.
Yeah.
Yeah. So
it's not a statement on the economy. So I mean
right.
that could be massively bullish. No rate cut, but some QE needed to manage the plumbing.
Exactly, and that's what we're getting into with that repo. So I could definitely see that being the way they go. So, all right, Brett. Well, we're just a little bit over an hour here, so going to cut this off at this point, and look forward to talking to you tomorrow, where we could take this conversation back up.
Spectacular.
All right, talk to you soon.
Okay.